All right, let's jump right into this explainer. Today, we're diving deep into an anonymous expert report that breaks down a seriously sophisticated financial framework. For most of us, the tax code just feels like this unavoidable penalty on success, right? But if you really look under the hood at the underlying mechanics, it actually functions as a meticulously engineered engine for building generational wealth. So we are going to meticulously deconstruct this exact cause and effect loop that elite financial circles commonly call buy, borrow, die. To really grasp how this mathematical engine works, we'll quickly follow this roadmap. First, the tax code incentive system, then the buy phase. Next, the borrow phase. After that, we'll look at the arbitrage wealth engine, followed by the die phase for the ultimate tax reset, and finally, structuring multi-generational wealth.
Okay, starting with Section 1, the tax code incentive system. So we have to establish the foundational premise here. The experts point out a massive disparity that this strategy exploits. The system heavily penalizes realized ordinary income, meaning the money you earn from your actual active labor. By taxing earned income at high marginal rates, which can hit 37% the exact second it drops into your bank account, the system creates this massive drag on your wealth creation. But on the flip side, the system absolutely continuously rewards passive asset accumulation. The structural logic here is that as long as you simply hold an asset, those unrealized gains are taxed at exactly 0%. This brings us to the crucial insight from the analysis. This whole strategy relies on an interconnected, three-step linear engine. You start by strategically acquiring very specific asset classes. Then you move into an advanced leverage phase to pull out liquidity without triggering any taxable event. And finally, you wrap it all up with a highly structured, legally binding wealth transfer. Let's see exactly how these gears turn. Moving to Section 2, buy, capitalizing on unrealized gains. The whole concept of unrealized gains is the central pivot point of this entire system. Basically, an unrealized gain is just the increase in the value of an asset that you haven't sold yet, which means, legally, no taxable event has been triggered. The implicit assumption in this first phase is that you aren't playing that traditional everyday game of buying low and selling high. Nope. Instead, you're playing the long game of permanent accumulation. You are effectively operating in a vacuum that is 100% insulated from the drag of capital gains taxes. But here's the catch, and it's a big one. This entire strategy fundamentally relies on selecting assets that reliably appreciate. This is the hidden risk variable the experts are always monitoring. If your underlying assets stagnate or worse, depreciate, the whole mathematical system is at risk of total collapse. You absolutely need things like real estate portfolios, broad market index funds like the S&P 500, or specific high-value equities. Why? Because their long-term compounding growth is the exact mathematical force you need to outpace the borrowing costs we're about to introduce. If your collateral tanks, a bank can issue a margin call, force a sale, and boom, your tax shield is destroyed. So, high asset quality, totally non-negotiable. All right, Section 3, borrow. Extracting tax-free liquidity. Once you've accumulated those stable assets, we enter the leverage phase. And this is analytically fascinating because it flips everyday financial advice completely upside down. The report highlights a great quote: "The wealthy do not fear debt, they fear taxable events." I really want you to let that sink in. For the average person, debt usually means financial distress, or maybe funding an impulsive vacation on a high-interest credit card, right? But in this framework, debt is a calculated, highly strategic mechanism engineered exclusively to bypass taxation. It's simply a tool to access the value of your wealth without ever legally recognizing it as income. This dichotomy right here is the hinge of the entire operation. Think about it. If you need cash and you sell your assets, you instantly trigger a taxable event. You could permanently lose up to 20% of your capital to the government, and you instantly kill the future compound growth of those sold shares. But the IRS views loan proceeds as a liability because you have an obligation to repay it. It goes on your balance sheet as debt, not income. So, by logically reclassifying your access to capital as debt rather than a realized gain, you keep full ownership of your golden goose, you keep capturing that asset appreciation, and your immediate tax liability is exactly zero.
So how do you actually do this? Well, depending on the asset class, experts know there are a few specific vehicles used to safely extract this liquidity. We're talking cash-out refinances on commercial property, margin loans, or securities-backed lines of credit, SBLOCs, against an S&P 500 portfolio. These tools basically act as a specialized financial pipeline. They let you pull out spendable capital for immediate use while your underlying collateral just sits there, safely locked in place, compounding uninterrupted in the background.
Let's move to Section 4, the Arbitrage Wealth Engine.
Now we dive into the mathematical engine of the strategy. This is where those borrowed funds are deployed to acquire even more appreciating assets, creating this incredible compounding loop. Let's look at the actual mechanics in practice. Imagine safely borrowing $700,000 against a $1 million stock portfolio. Now, a disciplined investor isn't taking that $700,000 to buy a luxury yacht or fund a lavish lifestyle. Instead, they strategically reinvest it directly into new, income-producing assets to create a powerful mathematical arbitrage.
Let's walk through the exact arbitrage calculation on this table. Your original $1 million in collateral, untouched. It continues to appreciate, let's say adding $100,000 in value over the year. You then use that borrowed $700,000 to buy a brand new asset. That new asset generates its own cash flow of $70,000, plus an additional appreciation of $42,000. Even after you subtract the $50,000 it costs to service the interest on that debt, your total net gain across the whole portfolio is a highly positive $162,000. The combined yield easily, vastly outpaces the cost of borrowing.
And here is the real, actionable, non-obvious insight. The debt effectively becomes self-liquidating. Plus, ironically enough, within the tax code, the interest and operating expenses tied to that new investment actually create further tax deductions. So the loan is eventually paid down organically by the cash flow of those newly acquired assets, or by periodically selling off just tiny, fractional shares of the highly appreciated collateral. You aggressively minimize any tax footprint while your portfolio just continuously expands. Which brings us to Section 5, DIE, the ultimate tax reset.
This is the final critical mechanism in the sequence, and it provides the ultimate, entirely legal tax reset for everything you've built. We're talking about the step up in basis. It is a fundamental, almost magical feature of the US tax code. By definition, it instantly resets the cost basis of an inherited asset to its exact fair market value on the date of the original owner's death. The crucial analytical point here is that this specific provision legally wipes out decades of deferred capital gains liability in a single instant. It allows massive amounts of wealth to transfer completely intact without a huge tax bill eating into the principal.
Let's trace exactly how this systemic erasure plays out. Say an asset grows from an original purchase price of $1 million up to $3 million over the owner's lifetime. When the owner passes away, the heirs inherit that asset at the new $3 million cost basis. Remember that $2 million of taxable gain that accrued over decades? Poof, it vanishes. It's completely erased by the tax code. If the heirs decide to sell the property the very next day for $3 million, their taxable capital gains are mathematically zero. Any outstanding leverage loans from our earlier borrow phase are simply paid off by the estate's liquid assets, leaving a massive, entirely tax-free transfer of generational value. Finally, Section 6, structuring multi-generational wealth. Because bypassing capital gains is really only one side of the coin, right? Preventing the government from taxing the massive transfer of the estate itself is the final step. Now, as detailed in the expert analysis, the federal estate tax exemption is incredibly generous right now by historical standards. Based on current projections, we're looking at around $15 million for individuals and $30 million for married couples. That means, for the vast majority of people, running a smaller scale version of this strategy, The estate tax threshold makes wealth transfer a total non-issue. The strategy literally concludes successfully without needing any more complex planning. However, for those massive estates that do heavily exceed those $30 million thresholds, experts deploy advanced structural vehicles. They use complex legal wrappers like irrevocable trusts to legally sever the owner's ties to the asset. They use SLATs, or spousal lifetime access trusts, which let a spouse benefit from the trust's assets while simultaneously removing them from the taxable estate. And then there are ILITs, individual life insurance trusts. These hold insurance policies entirely outside the estate, and their massive tax-free death benefits pay off those underlying leverage loans effortlessly. These tools ensure the wealth transfer is completely intact, keeping that compounding engine primed and running perfectly for the next generation.
Which leaves us with a pretty provocative final thought about the true nature of our financial systems. The tax code isn't just a bill you have to pay, it's a complex rulebook that rigorously rewards specific calculated behaviors while penalizing others. Understanding the underlying mechanics of this engine, that's merely the first step. Actually executing it requires strategic intent, a deep understanding of cause and effect relationships, and some serious financial discipline. It forces us to analytically ask ourselves, how will you stop merely reacting to taxes and start architecting your own multi-generational wealth? Thanks for joining me on this explainer. Keep analyzing, keep learning, and I'll catch you in the next one.